Hello, everyone, and welcome back to the Petronerds podcast. This is episode 83 of the Petronerds podcast. It is Friday, May 12th, 2023. Happy Friday to everyone. This podcast is not recorded. I'm going to do a nice introduction and recap of the markets for everything happening in the world right now as of May 12th, 2023. But this podcast is an awesome, pretty off the cuff, not off the cuff, but a relatively non PC podcast that I gave when I was in Washington, D.C. A few weeks ago on April 18th, 2023. I was with my old employer and nonprofit, the Energy Policy Research Foundation. They were having an event on energy security, and there was a gentleman, Larry Goldstein, who's a board member, who spoke on the Saudi side. There was a Japanese representative talking about a Japanese consulate representative talking about Japan and the G7 and G7 Communique, and I was there speaking about U.S. shale and U.S. production and what's going on in that space. And then there was also lots of folks on the political side talking about what's going on within Congress, etc. So my presentation was on U.S. shale. It's sort of a precursor to a paper that's going to be released with the Energy Policy Research Foundation that I wrote called Unconventional and Underestimated U.S. Shale. And really, this presentation and this talk that you're going to hear is a sort of fun walkthrough of what's going on in the U.S. shale space and why I think it's really critical for policymakers to understand how important it is that the messaging and understanding of the regulatory side of what's going on in Washington, that the folks in on the ground who are putting the drill bit back into the ground and who have to create a strong investment narrative around that they have certainty around that. So we talk about U.S. shale production in the context of national energy security, and that's the point of this presentation. So I think you guys are really going to enjoy it, and I look forward to hearing the feedback. So keep in mind that was April 18th, 2023. That was a few weeks ago. The presentation is very U.S. shale focused, so it is not ruined by being delayed a few weeks. And prices at that time point were $80.86 for WTI, because we were coming off the back of all the OPEC cut moves. Now, since then, today, May 12th, 2023, just a few weeks later, we have really come off these prices. We have seen 69 and change. We have seen oil prices hover around the 68 level. Right now, WTI is 70 bucks, 70.04. We've really seen some serious narrowing in the Brent WTI spread, which is very positive for many folks. But that's narrative, just $4. Brent is 74.17. Nat gas is 227. Nat gas is still getting absolutely murdered. And Dutch TTF has really fallen. That is at 10.46 right now. So this warmer weather across the world, in terms of an unseasonably warmer winter and less heating days required, has really impacted nat gas. That being said, the global economy is not in a good position. So I think I've been talking about this before. I talk about this a lot in various presentations. There will be another podcast release on my trip to Midland and a presentation I gave to the Society of Petroleum Engineers last week. Super fantastic trip. I'll get into that in a second. And a really great presentation, which I think you guys will enjoy. But right now in the global economy, there's not a whole lot of positive sentiment, right? There's nothing sort of out there. We've got Janet Yellen, she's at the G7 right now in Japan, meeting with folks, and there's talks on the debt ceiling. So she keeps getting on TV and talking about the debt ceiling. So we had softer economic data out of China that continues. All these economic data points out of China continue to be softer. They had their big holiday a couple weeks ago that did not prove as positive as people expected. There was an increase in services, but there hasn't been an overall robust increase in anything else. So it's not really driving oil demand. So I think you have to look at oil prices in a couple different ways, and that's that oil prices are getting moved on sentiment. They're getting moved on news. We have thinner trading volumes on contracted WTI volumes. So you're getting algorithmic trading and lots of exacerbated swings. However, you are also seeing crude oil really probably trade the market better than most trades, right? It's sort of a looking at these recessionary factors. So lots of things. The recession word is, you've seen the stock market come down this week. The debt ceiling or worries that the U.S. will default on the debt, not really being priced in on individual stocks necessarily. You have but apart from that, you have a lot of businesses, so-called businesses, saying obviously it would be very bad to default on debt. We'll get into that in a second. It would be bad to default on debt. However, we've done it before. It doesn't actually hurt usually the day-to-day consumer the way that I think a lot of politicians are making it sound like it would. But we should expect oil prices to be dampened if we're having commodity prices overall this week, especially copper, and on the sentiment out of China, weaker economic data out of China. On the China piece, I would also caution everyone. We see Europe is looking to make better trade deals with China. Janet Yellen is sending very, very mixed signals with regards to China. The U.S. is sending very, very mixed signals with regard to China. I think the U.S. is, just like the Fed, is doing a very, very poor job of sort of talking about and illustrating where we stand on China with regards to trade and the economy and with regards to national security. Unfortunately for Janet Yellen and for the President of the United States, those are intrinsically related. So China, the trade that we have with China is intrinsically related to national security, especially when it comes to solar panels, and all these things. And if you hear the stuff with regards to solar panels in China and Biden saying that he's not going to restrict imports of these solar panels from East Asia, the reason that's a really big deal is because we banned solar panel imports from China. They were coming from the province of Xinjiang, where there's documented forced labor, largely, concentration camps, forms of camps with forced labor for Uyghur Muslims and others that are producing these solar panels. So we were restricting our solar panel imports, but basically China and almost all of this polysilicon comes from the province of Xinjiang. So what happens is that they push this all the way to other countries, to Vietnam, to Malaysia. And so now we're getting these solar panels from East Asia, but these are just Chinese solar panels. And so the U.S. is looking the other way and saying, hey, this is not a big deal. We need these solar panels. We'll be fine. This is something I brought up before in the context of energy security. It's very similar to what Europe thinks that they're doing. They're importing a ton of solar panels. They've had 122% increase of solar panel imports from Europe, from China to Europe over the course of 2022 during the war in Ukraine, and that they basically think, hey, Kate, we'll look away from the human rights abuses. We'll look away from the life cycle emissions from this being produced by coal and how messy this is. And once we have these solar panels, we don't have to worry about, because we have them. The trouble is you do have capital refreshment costs, and you do have to replace these solar panels over time. And this is a Chinese product, and not likely a well-made Chinese product. So some solar panels you have to replace within 1 to 2 years. Some of them may last 12, some of them may last 15, but they probably don't last the lifespan of the 20 that people are expecting. So that's it. That is a very huge issue, and something within the energy transition right now, and stuff going on with the Inflation Reduction Act as we speak. But continue to expect lingering data points, continuing data points on China to come in weaker, and that to impact commodity prices and in turn impact oil, and oil being traded as this sort of trade of recession, and fears of softer demand, which we're already seeing really materialize in the global economy. So the debt ceiling, I do think we should spend a little time talking about that. We'll talk about Jamie Dimon's comments with regards to stickier inflation as well, because we had two big reads of inflation data this week. We had the consumer price index and the producer price index. And I think if you're listening to the stock market, you probably heard some incorrect commentary with regards to what those are. There's a lot of, I think it becomes very, very political, both the debt ceiling and inflation as well. But right now, with regards to the debt ceiling, you have, and there's stuff going on with the Fed and the FDIC as well with regards to all these bank fallouts. But there's a number of things going on with the economy, from inflation to inflation data, which was high, to the Fed and not doing a good job of telling the market what they're doing, as well as the Fed basically going to big banks and saying, you have to pay us now for all the big bailout that we did of Silicon Valley Bank and the other banks that they bailed out, because they bailed out everything, not just the insured deposits, which was unprecedented. Now they're going to the big banks to pay that tab, which I think is definitely unfair, given that they bailed out billionaires and millionaires within Silicon Valley Bank. So I think that was a little inappropriate. But the debt ceiling problems that we're having, probably not they're probably weighing into the stock market to the tail end of this week. But it has become very partisan, as it always is. And right now you have McCarthy on one side with the House as a Republican. You have Biden on the other side. They were supposed to meet earlier this week. They agreed to wait on that, and they'll be meeting next week. There is a risk that that the deadline comes due, and that things don't get paid off immediately. Now, interest payments, the prioritization would be to pay off interest payments on treasuries, and then and to make the biggest stuff, right? The biggest stuff, military, everything that we need to spend on. But we have done this in 2011, and you can have delays on payments. Stuff eventually gets paid, unlike when we had during COVID, where people couldn't get evicted, and you had a lot of homeowners who were renting their homes who never got paid rent. So everyone keeps saying the US cannot be the deadbeat dad, that the US has to pay their bills and we pay our bills. Well, yes, that's important, but that didn't seem to be the case during all these other policies. And things that Republicans are asking for are that which there's a lot in there that could potentially be up for grabs, but what they're asking for is that the COVID related money be clawed back, and that be put back into the system, and to pay down debt. And they're also asking that folks that are getting aid from the government, particularly food stamps, have to be employed or work to get employed. And the reason the employment piece matters, and the reason this does matter is because there are independent surveys from the Congressional Budget Office that talk about how much spending this administration and Congress has spent and how that has contributed to inflation. When you spend a lot of money, it's inflationary. That's just a reality. It's not political. It is a reality. And then when you have lots of fiscal lags within the system, you don't have an incentive for people to go into the workforce, and that creates lags as well and inflationary issues. And so we had inflation data this week, which was looming issues with the debt ceiling. That is going to be ongoing until the shoe drops. So that's the space to continue to watch. We'll continue to talk about it. But what it matters in the context of all this inflation issues is that we still have 3.4% unemployment. We have nearly two job applications for every one opening. The data that you might have heard, the unemployment went up. That data came out today that from the state of Massachusetts, that there was a lot of fraudulent unemployment data within there, that skewed the data to the upside. So that's probably not truly correct. So the market might have rebounded on that, thinking, hey, this is good. What the Fed wants to do is increase unemployment a little bit, soften the economy without cratering the economy, and cool off demand and loosen price levels. That's not really actually happening. What happened was that we see real hourly earnings in April go up by 0.1%. So they're still going up. If you're looking at the Michigan Consumer Sentiment Survey, not a good sign for the Fed, not a good sign for anyone, is that sticky inflation, inflation expectations over the longer term are actually trending up. That is a big, big problem, because that means that folks will continue to ask for higher wages. Folks will continue to bake this into their spending levels, and that will mean that inflation will maintain its persistence. So overall inflation also is at 4.9% for the month that came out this week. That is a problem, in that the overall inflation has come down a smidge, but that's basically because of energy. But core inflation is actually up. It's at 5.5%, and it went up 0.4%. So all items less food and energy actually went up. Same thing I've been talking about for a while. It's because of service costs, and it's because of shelter prices, which continue to go up. So the other thing I just want to mention is how important this sticky and persistent inflation is. And if you're listening to the stock market, or you're reading Financial Times, Wall Street Journal, or any stuff on this, I think people don't realize that it's not just the higher interest rates that have impacted banks and people spending. It is increasingly inflation. When you have less money in your pocket, you spend less. And we see that impact on discretionary items. So big ticket items, one, if you were financing them, it's too expensive to finance them. Yes, but you also just have less money to spend on them. And that there's a double whammy to this discretionary sectors, because they have had a harder time of passing on inflationary costs to them, especially now, because the consumer can't afford it. So they're just not buying it. When it comes to food, we've all eaten it because everybody increases the price and the businesses do well, but the consumer is really penalized. And so that's been this weight of inflation. And even if the inflation rate comes down, overall prices are not ever going to come down. It's just the rate of the price increases that slows. So you're never going to see lower prices at Chipotle. The interesting thing is, when you think about oil prices actually come down, and you see a sticker price on gasoline prices. That actually moves down. The rest of the economy, things basically stay the same price. Now, you can have big tech changes within TVs, and those prices come down. But for most things, it is sticky and it's persistent. So these lasting price increases, especially in food, are really, really damning to the average consumer in the US economy and the global economy and consumer. So super big things to just think about in that standpoint when you're thinking about in the context of recession. This recession is coming, whether people want to believe it or not. It's sort of there. We just haven't had that major shoes dropping, but we have all kinds of shoes dropping, from the bank failures to the debt ceiling to everything. I mean, one little thing has to give for this to really come cratering down. And the last thing I'll say on just two things and wrapping up is that, Jamie Dimon was interviewed by Bloomberg. He made some comments with regards to he has been consistent with his comments with regards to sticky and persistent inflation, saying that the Fed is going to have to maintain rates for higher than people expect for longer because of the sticky and persistent inflation. I beyond agree with that, have called for that since the very beginning. If the Fed does cut rates, that is an inappropriate thing to do when you have this high and sticky and persistent inflation, especially when it comes to food and your everyday items. So that is a big problem. And you have to have an incentive and alternative to put your money. You have to be able to offset some of that inflation, and CDs and fixed income are doing that. So the last thing I'll mention is please listen to the latest podcast. They are phenomenal. If you haven't listened to the podcast with Daniel Siever, episodes 81 and 82, the feedback on them is incredible, as is the previous one, episode 80 with Brian Keys. These are really frank conversations, and we get into a lot of the topics that I've been working through with clients and giving presentations. I was in Midland last week. If you haven't, so that will be dropping in a couple weeks. I'll be putting out that presentation and talking about that trip. Was able to go to the field with an operator. It was fantastic. We talked a lot about emissions and the energy transition and everything happening. And Midland is just a completely different world. I can't encourage folks enough to go visit Midland, to fly in, to look out the window, and just to talk to people on the ground and appreciate how different it is than, say, Colorado or Pittsburgh, where folks are afraid to talk about energy, even though they're producing it there. And Midland is very much an oil town, has always been an oil town, but it makes a huge difference in the ability to actually drill a well. There's drilling within the city. They have sound walls up, but they still have drilling within the city. You have pump jacks in people's backyards. So it's a very, very unique place. It's awesome. The Permian Basin Petroleum Museum should be a must-have for every regulator, every policymaker. Anyone who is touching energy but doesn't know it really well should have to see that. And lastly, I was quoted in the Financial Times. This is, again, something I've been working on a while. I think this is really important and serious for people to appreciate. So those quotes in the Financial Times are with regards to share price performance and the lack of love for oil and gas. And I think, sometimes when I'm talking about ESG and the energy transition, it may sound like I'm just sort of, ripping and talking about greenwashing. But the reality is I think oil companies have to be very, very serious and cognizant about how they're talking about emissions and ESG and the energy transition, because it is impacting their share. It could be impacting the share prices, and I believe it is. And that the incentive for the retail investor or the generalist investor or the average investor to want to be in oil and gas, the story about emissions and net zero 2050 is skewing that, because net zero 2050, according to the International Energy Agency, is a 25 million barrel a day demand drop by 2030, which means most folks are out of a job. And that means that if I'm the generalist investor, I don't think if I don't think this business is going to be around in 10 years, why would I be buying that stock for long only? So I think it's really important to think about this. I'm summarizing that, and that's very brief, but putting this in the context of investment and where these companies need to be talking about, and the industry needs to be talking about this industry, the longevity and the story of their businesses and what they do, and why folks should invest in them. So that's something that has to be addressed and mentioned. This comes back to the piece on education, which I talked about with Daniel Siever. But with that, I really, really hope you guys enjoy this presentation. It was super fun. You'll hear a lot of laughing and joking within it. I basically talk about I don't have to be as politically correct as the rest of them in DC. So hope you guys enjoy it, folks. Talk to you soon. Bye. The blessing of formerly working for Lou and now working in Denver and having my own businesses, I am not as politically correct as the rest of you, and that's how I run a business. And so there are some large elephants in the room, like the energy transition, like China that hasn't been mentioned, and I do have the G7 Communique, so you're 100% on point. And when we're talking about U.S. oil and gas production, you have to be thinking about really serious things like policies, like what is the investment, what is the investment horizon? Do companies feel like they can invest? And I can tell you right now, they do not feel like they can invest. They do not feel like they're given a long-term platform. We do have the most anti-oil and gas administration we've ever had in the history of the United States of America in office today. That is a problem for producers who have to put the drill bit into the ground and have to make the argument to their backers, the people who are giving them money, that this is a good idea to invest in this. And yeah, shale, luckily, we can drill this stuff pretty quickly. But you can see this really big, messy mix right now between public operators and private operators. And it's articulating itself through what you guys see in DC, what you see in New York is, what is U.S. shale actually producing and what's the future of it? And the public operators and their sort of entrenchment in this thesis of the energy transition and everything happening is giving a bit of a different skewed view that U.S. shale just cannot produce and we're kind of stuck where we're at. and the public guys are never going to drill anymore. And part of that's because they have caved a lot on the energy transition stuff. But we do have a lot of private activity, and when we look at this, you can actually say that the rock is doing something else. So I cover the entire global oil market, but I did cut my teeth on U.S. shale and specialize in it. So it is fun to get back into it now because no one's paying attention to it. This is the first time people are starting to actually question what's U.S. shale doing, and it actually looks pretty good. Where am I pointing this?
All right.
Sorry. Okay. So we'll really quickly go through drilling and production activity, the public versus privates, which I think is something people are really missing, and then we'll talk about production, and you can actually see it. And I think the regulation, the sentiment, the hurdles, the G7 Communique, very, very serious stuff that cannot be underscored and underestimated of how important that is. Because if you want LNG 10 years from now, you've got to have an investment climate that the operators want to drill for oil and gas. And I know no one believes we're going to need oil and gas past 10 years from now. We're probably going to need it 50 and 100. So you damn sure need to be harnessing this because we are the largest oil and gas producer in the world. And that's not, people don't say that either. Certainly this administration doesn't say it. Okay, so next. All right, so U.S. oil and gas production, 12.5 million barrels per day is oil production. You can see we declined during the COVID drop, clawed our way back. It's really important to think about how hard these operators have worked in this clawing back. So when all the stuff you read in the Wall Street Journal and the Financial Times and how, shale's just not coming back and it's too slow, this is pretty impressive, and you're going to find it more impressive when you see the actual numbers and activities that support this, because we've done a lot more with less. This happens every time in U.S. shale, no matter what, happened from 2010 to now. Every time the industry gets sort of pushed back and has to press pause, they do a little better. Gas production is 123 billion cubic feet per day. That's total gross withdrawals out of the U.S. Now, we have a 400 BCF a day global market. The U.S. is producing 123 of that. We have enough gas, but the point is that in terms of a productive capacity and what we're producing and why we have gas price problems, it's because the gas just does this, and because we have so much associated gas. So that production, 12.5 million barrels a day, is pretty impressive given where we've been. Now, this is your historical rig count chart. Doesn't seem very impressive. You all have seen it a million times. It is, though, when you sort of stare at it a little bit. And the reason why is because, we're here. And we've dropped a little bit in recent price decline, but we're right here. We're never going to get back to where we were pre-COVID. But we don't really need to. If we're 12.5 million barrels per day, and I'm going to show you that we're not back to the well. We're not completing as many wells as we were before. But we're doing a lot more with less. So we probably don't need to come back to these rig levels. And we didn't need to go back to these rig levels before because everybody does a little more with less. Laterals get longer, everybody gets more efficient. And this is with all this investor pressure. And it is really important to think about. There has been incredible investor pressure. The anti-oil and gas movement has definitely impacted how operators think about oil and gas. And that's important to consider when we all use it every day and we want oil prices. And it's so important for the geopolitical standpoint of this country. This is where we're at on the rig count now. We came off the COVID, we came down, and we've been sort of flat, and we're right here. Important to note is that all that natural gas production, most of that's coming from associated gas. So this is the natural gas rig count. We have not seen the natural gas rig count drop heartily from when we had $10 an MCF in August to $2 and change today. And that's because so much of these oil operators, they're impacted by the gas side, so they'll drop a little bit. But the point is that you're just not going to see, unless we saw a decline in oil prices, you're not going to see a material decline in natural gas production. There's an incentive for everyone to go off gas, and I have a bunch of gas slides in here that'll talk about that, but we've done a lot more with less. So our average lateral length, and I know this doesn't look like a whole lot, this is 2016 to 2023, but your average lateral length, average.
So Trisha, maybe you could explain what you mean by lateral.
So when you're drilling 2 miles into the ground, typically, this is just for the Permian Basin, for example, but all of the US, the average lateral length, that horizontal lateral underground, is on average about 2 miles long. But during the course of, since COVID to now, especially in the Permian Basin, we have seen a significant uptick. We've actually seen it in the Marcellus, we've seen it in the Haynesville, we've seen it in major gas plays where we're drilling significantly longer laterals. So that once 2 mile long lateral is easily 3 miles in many places now. And you hear a lot of companies talking about that. And part of that's because it's cheaper. I mean, it's more efficient from an above ground capital cost standpoint. If I'm drilling less wells, I have less above ground stuff. But the point is that it really does matter when we start talking about production and productivity and are we losing, as our lateral length gets longer, 2 miles underground and it's 3 miles, are we losing production from that? And the reason you didn't see that 5 years ago was because there was concern that we wouldn't be producing as much from the toe or the end of that well. And that has really, the baby's gone out with bathwater, and we don't see that actually in the data. We've seen pretty good productivity. But on average, we're almost 12,000, we're at 12,000 feet in Midland, in the Permian Basin for an average lateral length, which is just extremely impressive. So it's these small sort of incremental gains that have had big movements in terms of production and productivity.
Trisha, what was the last point?
I'm sorry, what?
Your last data point.
Oh, that's just the data that's not smoothed out. The next month that'll clean up and it'll go the other way. I mean, it's just data point. So typically it's that curve, but I don't like to lie with data, so I'd like to keep it there to show you that it's real. But that could be one company that pulled it down because they drilled something shorter. So this shows you, and this is just a snapshot. I know it's a little messy. I'll show a little better in this next one. The public versus private companies. Now, these are your major basins, Williston Basin, you got the Rockies plays, you got the Permian Basin right here, you have the Eagle Ford, you got a ton of stuff going on in the Anadarko. To Max's point of all that, natural gas was sexy last year because you had high gas prices. It allowed oil companies to actually go after condensate, to go after natural gas liquids, to go after gassier areas in their oil portfolio, which they've not wanted to do for 10 years. So this is the first time we had $6.50 in MCF last year for average all last year. You had people wildcatting gas wells everywhere. And what you see is the purple companies are the privates. So these are the current snapshot of rigs right now. The orange companies are the publics. And you can see orange companies the publics are very cored up, right? They're really concentrated. They got their acreage down. They know what they're doing. These are stellar wells. They always talk about, we don't, acreage running out. Well, if we were really running out of acreage and that tier 4 acreage was such crap, then why do you see all the purple guys drilling everywhere? I mean, the privates, private equity money, they still have to defend their dividend and they still have to defend their return. So it's not like people just give these guys money and they don't make a return. So that's just what it looks like right now. And if you don't believe me, this is the DUCs, your drilled but uncompleted wells. And we don't need to argue and get into a debate about what a DUC is. The point is that these are wells that have been drilled and a hole has been poked into the ground with a drill bit, and they're waiting on some stage of completion. So they have been done. A rig did do this. These are all the privates. That's insane, because that's your publics, and those are nice, beautiful, cored up pieces, and this is your privates. That is telling you a completely different story. They're willing to take a bigger bet than these guys. And it can't be that all these are bad. It can't be that every single one of these just suck and that we just run out of acreage. So it really has debunked and disproved a lot of this. We're running out of acreage. And a lot of this stuff, if you're feeling conflicted with some of the things I'm saying, it's because a lot of folks have not really paid attention to U.S. shale in a long time. They've done these deep dives and understanding.
This is fascinating. Can I just ask a quick question?
Yeah, please.
So I'm not asking you to tell me what you think the motivation is, but I'm guessing what you're saying is that the big guys, the publicly traded companies, they're not out there because the returns are less. They're not out there because it's too risky, or maybe is it a kind of systemic thing with the big corporate? They want to be in one place. They want to get the long-term economies of scale. Can you really parse out how much of that is ESG and government opposition versus a kind of fundamental economic strategy? When you talk to them, what do they say?
Well, yeah, so if you haven't listened to the Petronerds podcast, you should, because there's a lot, I have a lot of folks on it that are public and private, and they tell you very different things. Yeah. And it's nice to have a debate. So your question is really good, and I think I can show this in some data points. Parsing out perfectly how much of, these are, this is your rig count for your publics and your privates. Your private, this is all the rigs right now in the U.S. Privates are in red, publics are in purple. So what this is telling you is that you have more, you have still, everybody's come off a cliff, but you've got more activity by the privates than you did pre-COVID. So why, to lose question, are the publics just not, is it ESG, is it investor pressure, what is it exactly? They're using a lot of different things. So they are using a bit of an excuse that, hey, we have this investor pressure. This is a great time to return money to shareholders. They absolutely needed to return money to shareholders because they had squandered a lot of cash previously. But that being said, Is share buybacks the only thing to do? I mean, is it the smartest thing to do? Investor pressure, unlike inflation, and the Fed got it wrong, investor pressure is transitory. It does change. So, several years ago, we were doing share buybacks, and companies were using debt to buy back shares when they weren't making money. That wasn't very smart. And share buybacks is kind of transitory. Dividends is very hot. I mean, you want to be a dividend company right now because you want somebody to be incentivized to put your company in a portfolio and in a long-only portfolio. I think the share buybacks will probably bite operators, some of them, in the long run because it's $83 oil right now. I would wager this is a pretty good time to put the drill bit down to the ground. And maybe if they had boards that would talk more like this, and opposed to ones that are pumping the energy transition so much, the board members would say, hey, we should probably be drilling for oil too, and we shouldn't be investing in the long haul. But everyone's afraid to say, I heart oil and gas, even though they drill for oil and gas for a living.
How much was impacted by the period of low interest rates and the banks willing to lend? And how does that change now with higher interest rates and the banks a little bit more tight on either capital or the cost of borrowing that money?
Well, I mean, we have a ensuing banking crisis just sort of sitting upon us, and this potential commercial real estate, and something that people have not spoke about is the oil and gas side. The exposure on oil and gas, and I talked to clients of mine, and I talked to various companies, and regional banks, you have to start questioning, the exposure that regional banks have with their operators. And trust me, the love for oil and gas is not going to be there like it was for SVB bailing out a bunch of billionaires in tech. They're not going to care at all if a bunch of oil companies go under in Midland and people go under with it. But the exposure is really serious, and so I think you were hearing last year as interest rates were ticking up, some operators were having issues. Some of them were doing fine, but most operators, a lot of them, are making a crap ton of money from operations. So we don't have the same problem. I mean, we still have debt issues and money and banking, but you don't have the same issues you had 10 years ago where you weren't making money from operations. Now you have a lot of production. Oil prices are $80 a barrel. And so if you've got that production, you're making money from operations. The difference is before we would have drilled with that, and now we're not. So, and you have this investor problem where you've got a group, half of you, and you're in a boardroom, and people are pretty damn confused on what the hell to do. And they're torn between the FT and the Wall Street Journal and, energy transition here and there, and it's so green, and we're not going to be in business 10 years from now, and it's exhausting. And then you have all these layers of regulatory uncertainty, and we can't get people in the field, and we can't even get petroleum engineers because nobody wants to go to school for petroleum engineering because they're going to be doing wind and solar tomorrow, not petroleum engineering. So the hurdles are really significant. And as Lou and Everink has pointed out for a long time, crappy energy policies really have an impact on the long term. And we are in the heart of really crappy energy policies right now. That's your public-private rig count split. Just in the Permian, for example, it was neck and neck with publics and privates. It split out when oil prices dropped. Private companies are super sensitive to oil prices. They responded super quickly in COVID. When prices came off, the private companies went off to the races and the public companies held back. For all these reasons, they were slow. They took their time to even figure out what the hell was going on with COVID. But the shareholder stuff that happened in 2021 on the same day with Exxon, Chevron, and Shell in May of 2021 was a really big deal for them. This is Permian Basin oil and gas production. Basically the biggest growth drivers we've had in the US. And it's really important to understand this because every other play I showed you is largely dominated by public companies. And so those oil plays are not growing. The Permian is dominated by privates. So it is growing and that activity is there. And that's meaningful because that's just the map. But
Trisha, quick question.
Yep.
So, well, one question, two. How much of the limitations supply capacity rates privates are willing to take from the oil can, but the majors really want maximum lateral speed they can go? In talking to service companies, my understanding is that's unless you're willing to sign up for a 3-year contract, put capital up front, pay a crap ton of money for it, and wait 6 to 12 months for them to build it out, you don't get that. So it's been somewhat limited in that market. I don't know how much outside of ESG and the things Lou was asking about. And the other is how you coded public versus private, because I would have expected, for example, when Purple took the Continental back private to see a step change.
there's only a handful of those companies, and these are the ones with it's public versus private. If it's public and it's got a ticker, then it's public. If it's private and it doesn't, then it's private.
I understand the Continental is consequential. That one should be
Yeah, but it's not nearly as consequential because, as you know, the public's dropped their rig counts. So it's included in there, and it is included in the flip. But your question on, this stuff gets really nuanced and tricky, and there's a lot of excuses that people have about, okay, well, we just can't get enough rigs, and we just can't get the frac fleet, we just couldn't do this. And there's some truth to that in terms of when it was ramping up, when we were ramping up after COVID, there was a little bit of truth to that. Everybody grabbed the nicest rigs that were available, and they let the crappy ones that were sitting out, they weren't gonna take those back. They grabbed the nicest ones, but it was private companies, some of them in Colorado, that were drilling through the whole damn thing, completing these wells for nothing, fracking them for nothing, drilling them for nothing because the day rates were so low on the rigs. When everyone comes back and the public companies realize that they are going to be producing oil and gas for a couple more years, they had their rigs lined up, but it was the fringy stuff. It was that when they told the market, hey, could you add 20 more rigs? Because Exxon went from 55 rigs to 7. So it's a bit of a difference. So when they say, the market's kind of looking at them like, are you going to bring these back? And they say, well, we couldn't get them if we wanted to. And it wasn't just the rigs, they couldn't get the people. So the inflationary environment the inflation on the market is huge. And that is probably one of the single biggest weights now is labor in the field, the inflationary environment, and it's compounded for oil and gas because everyone hates oil and gas. So nobody wants to work in oil and gas. Nobody sees it as a positive, like, how long are you going to be here? And it gets really tricky. And that's why the messaging and the story of the U.S. being the largest oil and gas producer and that we're going to need this is so critically important, or we're not going to have it because people have to work in this business. And so there's several different factors. But you're correct. One of them is, availability of equipment, but it's really the people on that equipment and having the right people. And we have the industry, like every industry, like restaurants and everyone has struggled with that since COVID to now. This is greatest way to probably see that investor pressure in ESG in all different forms is the wells. So forget the rigs, forget the equipment that we talked about, this is the wells that you've completed. You've actually drilled and brought them onto production and they are in the system and they're completing. Private companies, this barred line is the wells, and that black line is oil prices, so you can see how easily they respond to oil prices, and the line that corresponds to the color are the rigs. So also tells you that you're not going to keep ramping up rigs, but you've added the wells. This is public companies. We've not come back to our well completions in the U.S. We're not even close from pre-COVID. So this is important. This has a meaningful impact to U.S. oil and gas production. And this is a story that needs to be told, and public companies need to be taking about this seriously because they're letting these guys eat their lunch. And that's just reality. That's Permian completions. That's just a comparison so you can see the same thing. The private companies in the Permian have just been adding those wells consistently. The publics just haven't come back. And on the productivity side, and I'll close with, I only have this and then we'll close with this productivity a little bit, is that with all the stuff I've shown you, with the private companies stepping out and they're not in the core acreage and not being able to get rigs and not having availability and having new people and having much longer laterals, all this would tell you that we probably should have diminishing marginal returns as we get in longer laterals. We probably should see some serious declines in productivity, and we don't. Because this is all U.S. shale plays. This is the Permian, this is the Anadarko Basin, this is the Williston Basin, this is the Powder River Basin, and this is the Eagle Ford, all together, normalized for lateral length. So I'm not picking a 4,000 foot lateral and a 10,000 foot lateral. This is all normalized to 10,000 feet. This is your productivity. And for 2022, we're not doing that bad. We're right in line where we've been for the last couple years. So you would expect that this to really come down significantly, and it hasn't, which tells you we are doing a lot more with less. And the rock's definitely not done giving. The other side of this is gas. To your point, Max, is the price was so good and it was so great that incentive to go after gas is also a driver for oil. It's associated, but it helps bring that up. So you've got areas in the Delaware Basin in the Permian that are 13,000 foot deep, it's hot, it's thermally mature, and it's got a massive gas production and a gas drive. And so when EOG is drilling that well, or whatever company, they're producing maybe 3,000 barrels a day, but they're getting 3,000 to 5,000 MCF a day of gas as well. That's helping drive that out. Now that was really appealing last year. So we saw the gas curve, that's the all-time high. This is 2022. The gas went way up in all those oil plays. Gas production is up massively. And that's telling you something. They were targeting gas. And that's why we have low gas prices.
Can I ask you something?
Yeah.
Sorry. I don't mean to steal your thunder, but To what degree does Freeport being offline affect the price of gas, especially in a play like you just described, 13,000 feet? Stuff's really great. It's coming up 5,000. I remember that you just cited.
It didn't impact it in terms of the production. I've shown that it hasn't impacted it materially.
But in terms of the fact that you didn't have someplace to move.
Absolutely. No, it's had a significant impact in terms of the market, which we can get into, I think, a discussion of where does this gas go, which goes to his discussion of, where's the LNG side. But this is your Eagleford, which is on the Gulf Coast. And you can see that it has condensate, it has natural gas, it has oil, and the gas side of this is the highest it's ever been in 2022 for productivity. Williston Basin is an oil play, the first shale oil play up way north in North Dakota, and that is the productivity curve for 2022. Everybody said the Williston is dead. That's not, it's just done. We can't do anymore. Clearly it's not dead. It actually did really well during 2022. I've talked about we went through this, that you can actually look at the numbers for shale reinvestment were really low. The impact of understanding how much of this fuel is actually in the mix is critically important. We do have to start changing our talk about energy transition and the realities in it. I don't even call them fossil fuels. I call them traditional fuels. It's crude oil, it's natural gas, and it's coal. And these regulations are massive. They do weigh on the industry. I speak with these executives and these business leaders all the time. And the impact and the stuff coming out of Washington impacts all these companies and how they see the market. And it's confusing as hell. And it's important that the industry does start articulating and pushing back and saying, what we do for a living and why this is important. All these things, recession, uncertainty, regulatory, labor, costs, permitting delays. If you look at the Dallas Fed survey, companies will tell you exactly what they feel. And they have these things that come out. And I've curated and went through all of them. Regulatory issues are one of the single biggest things, in addition to not getting people, in addition to costs, in addition to inflation, everything else. This is a very hard business. This is not easy. And this capital, no offense, but I mean, this DC and this administration is not making this any easier. And it's really important to realize that there are going to be implications for us in the future. The G7 Communique, I want to close on this because I think it's really, really critical. Where we're saying about investment now is going to matter how this goes down in the future. And I did not interpret this as favorably. This is a very long document, this G7 Communique. I've read the whole thing. It's pretty painful. It's very progressive.
It's really painful.
It's extremely inclusive. You got to get to the end to where we start talking about oil and gas. And this is where he meant to have this slide. So I don't want to take your thunder, but I do have this slide.
Thank you.
So this is where it says, and I had to the fact that it has to be qualified. So the whole paper is on the crisis and everything and how we're going to the energy transition. And then it says, quote, investment in the gas sector can be appropriate. Can be? Jiminy Crickets. It is appropriate now and for a long time. And I think countries have to, we would do a lot better if countries that want this natural gas, that need it, would push back harder and say it has to be included. And our operators need that, and we do need it for long-term contracts for LNG because Europe is not signing long-term contracts for US LNG, and we aren't getting LNG facilities built because the investors don't know about the long term. We all in this room know it's going to be around the long term, but we need the buyers and sellers and everybody on each side to do this. And business is hard. And so getting folks around this and sort of getting the politics aside and talking about business is extremely important. So this stuff really does matter because it comes down the pipeline. And LNG is a 50 BCF a day market, according in 2021, 50 BCF a day out of that 400 BCF a day. So if we want to grow that and we want to put this stuff on the water, and again, if we have 123 billion cubic feet per day in the US, we can damn sure add a lot of this stuff on the water, and every molecule that goes on the water is dropping that price. It's bringing security of supply to the global market, and it's making sure that our allies in our countries like Japan can actually get that whenever they need it. This is just the price for drilling a barrel of oil. We're not going to be shutting in crude anytime soon in the U.S. Prices are too high. There's a floor on prices. But this also comes from the Dallas Fed. Really great figures. The price to drill for oil has gone up, certainly because of inflation, but they're really profitable right now. So with that, I will close and thank you very much.
Before I just do a quick advertisement, so Trisha's been working on a paper for Equity for like 2 years. But it's done.
I wasn't working on it for 2 years, I just didn't do it, and I did it in like a night, so, yeah.
But it's the illustrators wrestling it to the ground, and I think, so if you're not on our mailing list, please see Will, so you'll get the paper when it comes out. And also, I should say, Pat has a paper coming out at Zero that's really interesting, I think it's going to be published by us, but also the Real Clear Foundation. So with that, and I will stop. Trisha, there must be some questions before we move on to Matt.
Yeah,
You are always fantastic.
thank you.
There's a tiny provision in the proposed methane regulation, EPA, that has me really worried. And it is to mandate, should the rule go final the way it's been proposed, mandate electrification of upstream production before the production can enter into market. Some of us that are on the electric side as well, I'm pointing to you, and you may not want to be drafted in, you have to say, I disagree with you, please, sir. But some of us are very worried because there's some of the same choke points, bottlenecks that you're talking about on the electric side. The production guys can't wait for the utilities to find the staff to drive the truck, to find the distribution transformers, to electrify the production. So I'm worried that some of those little guys that are, were they in purple, not yellow, some of the guys, independents, they may wither on the vine while they're waiting for the electric to electrify, meaning they can't use their own diesel or burn their own gas. They've got to wait for electricity. Forcing electrification on upstream production everywhere is one of the dumbest ideas.
Among the many things that come on. Yes.
That nobody seems to worry about this.
So that is a serious issue, and I have not read that document in its entirety. And I think that there's many dumb things that have come out on paper and have yet to be enforced. That electricity, as it is today, is also another point. So what I did put in here, because I was shortening all this up, but that's one of the points that you have operators saying they already have electricity issues in the field.
Yeah.
We all know that we couldn't all get EVs and plug them into the grid right now if we wanted to, because we'd kill the damn grid. So the whole electrifying thing is a problem in general. You'd also need to increase generation capacity, which we're not doing. So it's not going to happen. The energy transition is dead before it began, but this is part of it. And in the field, it would have an impact. And this is, a lot of operators, they've got so much stuff going on, they probably haven't got to that point yet of reading that stuff and understanding it. And you do have a lot of privates who don't appreciate that this stuff will impact them. They think right now prices are good and they're just running and gunning and they're doing everything and it'll work itself out. Because guess what, it always has in the past. In previous administrations, we've never had one like this. We've never done this. So the Obama administration talked big, but they didn't do much. And they let business sort of go. This one's a lot different because with those regulations, the EPA thing, as well as the climate change proposed rules from the SEC, those are really big. That's another 300-page document, sorry. Can't even remember. It mentions scope 3 emissions like 300 times. That's a pretty big deal for this. So I think that's just one of the many, but it is really serious. You are seeing companies, frac companies that are pushing into the electric side for, I think that's one of these many reasons, to just have that diversity. But I think Governor Abbott might have something to say about allowing his companies in his state, how they're going to do that. So you are having states that are pushing back on some of this stuff. Colorado is imposing extremely stringent air emission standards, which is probably another new fracking ban going in the way of California. So there's a lot of state stuff. But this stuff is just coming down the pipeline like crazy, and it is weighing on these guys massively. And it will come back it's going to hit everyone. But it is very serious. And we didn't even talk about the SBR coming down to nothing.